The word that I keep hearing is defensive. Defensive positioning, headwinds, etc. Is that your word of the week as well? Are you defensive right now?
I think my word of the week is optimism.
Okay.
And I think that the market, I think what's important right now is that people recognize that the market is not an intellectual entity. It's an opportunistic, efficient marketplace. And so if we overanalyze, we risk kind of going into these rabbit holes, and risk missing the bigger picture right now, which is a transformative moment with the installation of AI and deglobalization. So we marry, structural inflation with cost cutting, and we get to someplace new that I'm not sure people are really grabbing hold of yet.
You just mentioned like 5 different things that I would love to dig into. I think let's start with optimism, and also let's talk about AI, because when I hear AI, I think technology stocks. And if you look at what's driving the S&P 500 so far this year, it's absolutely technology stocks. Does optimism translate into some of those growth names?
I think it does, but what's different this time, this new moment of innovation, like I go all the way back to 1998 when I started managing portfolios. We launched the internet, a very different moment of innovation that put people at the center of their own self-actualization, knowledge-bearing execution, commerce, et cetera. This moment of innovation, though, is about removing people from the economic equation altogether. Now, from a profit standpoint, that benefits corporations. What that means for us as a society down the road is another matter. However, when it comes to sort of threading the needle between that and the cost of deglobalization and new infrastructure build-out with slowing growth and the installation of AI, I think it's applicable across almost all sectors.
It'll be interesting to see kind of how this plays out, not only just from a societal perspective, but also the investment perspective, too. I do want to pivot from that, Sherry, and ask you a little bit about just kind of that search for income, that search for yield that we saw over the last, I don't know, few months to a year or so, and whether that is actually moderating. Are people sort of looking now more for growth as opposed to yield, at the expense of yield?
Well, I'm going to go back to optimism, and like the market's giving you sort of an amazing setup right now. We have this innovation kicker, which could really extend this growth story in a way that you would think that interest rates would have put a damper on. And on the other hand, we've got treasuries at 3%, 4%, and 5%, and this meaningful opportunity for people to create a barbell approach that stabilizes portfolio through stable income, and at the same time kind of adding what I call the innovation kicker on the tail end in order to grow portfolios in excess of what is becoming structural inflation.
Structural inflation. Wow. So, I mean, we heard from Jamie Dimon yesterday, who seemed he didn't use those words, but he basically alluded to the same thing with rates staying elevated. And he's not the only sort of big person in finance who said something similar here, that this is here to stay.
Well, it feels that way because remember, globalization, which was 20 years ago with the internet, was all about synergies, collaboration, and removing pricing pressures through sort of this interdependent economic system. So as we deglobalize, isn't the opposite also logically sort of true, that as supply chains have to come onshore, we become more independent versus interdependent, the cost structures of supply chains start to go up. And so that is fundamentally structural, at least in my view.
Structural inflation, I'm really struck by that. So if this inflation that we're seeing is structural, it's not transitory, which I think we've done away with that notion. Does there need to be a reset? You look at a 10-year Treasury yield right now at 3.7%. Should that be structurally higher, reset higher, or have we already seen that?
Yeah, well, and I would go back because I think we had moments of transitory inflation that are now sort of reductioning down into a structural moment, right? So we've got sticky wages, we've got supply chain costs that aren't completely receding, and so. I think overall, the way that kind of gets baked out into the marketplace is going to be something a little bit different than we're used to. And so to answer your question, there's sort of, projecting interest rates is like the most difficult thing. However, look at how the market has already absorbed 500 basis points, and the technology companies. And so it tells us that the market is opportunistic, not necessarily intellectual. And I think that that's the thing that people need to sort of jump into, is that markets are forward thinking. There's something coming that may be better than we could all expect. And a balanced portfolio, in my view, is the best way to play that unknown with an optimistic bent.
I know you're much more of a long-term thinker and a long-term planner, just on the nature of what you do for a living here. I do have to ask you just a little bit about some of the short-term price movements and what that is telling us about sentiment, particularly when it comes to some of the volatility indicators, which I think have been distorted as of late.
Well, I believe long-term investing is the best way to compound returns, but from a portfolio management standpoint, we are actively trading sector weights. And so what the sectors tell us is that winners become losers and losers become winners. I mean, look at the three top performing sectors year to date versus the three worst last year. And so right now, actively rebalancing, I think, is key, and single stock selection is going to win the day because we're still living in this concentrated market cap return set. And that doesn't mean, though, that necessarily there isn't a lot of opportunity to buy those catch-up players, right? But I do think that people need to be careful about owning market-weighted indexes and things like that.
Well, to that point that, you know, the losers become the winners, when I think about last year's losers, what was it? It was big tech. So,
tech, consumer discretionary.
So is that the position then?
Well, if you look at the year-to-date returns, we've sort of recouped and reversed that, right? And so the key to good portfolio management is to take your winners and then reset portfolios in a rebalanced sort of way. And so if you bought into the market at the end of the year in those depressed sectors, your performance would actually look pretty good right now. And so being very nimble, liquid, and dynamic, I think, is crucial right now. This reminds me very much of the early 2000 time period where themes are shifting very dramatically, and even more so with AI.
Sherry, always wonderful to talk to you, always great insights. Sherry Paul,